Troy, at what point do 10-year yields become attractive to you, understanding what you just said in terms of just bonds losing some of that ballast type reputation?
So when you look forward, I mean, we've probably bottomed for inflation for the time being. We expect a modest reacceleration next year, nothing like 21 or 22, but, think core in the high twos, low threes, somewhere in that range. And so from our perspective, you take the front end of three. The soonest we could see that happen is the summer of next year. The latest is the end of 26. That means roughly around, high fours, 5%. Which is sort of where we were in October of last year when we were having the issuance panic and we had that big gap up in yields. Then you're starting to get to a point where, because of the roll down the yield curve and the additional yield, you have attractive yield, you have hedge protection, and you have roll down the yield curve. But for the time being, it's really difficult to get overly excited about duration, especially when there's so many other alternatives like private credit, for instance, or senior commercial real estate lending.
You say other alternatives, and then you go to private credit and other types of alternative lending. Are you saying that stocks also have similar kinds of hair on them in terms of just a valuation issue?
Well, yeah. So when you look at equities, we're going to get growth, right? The U.S. economy, your last guest was Dynamite describing the K-shaped progression of it. Obviously, lower-end consumers have been struggling for quite some time, have been hit hard by inflation, shows up in all the polling data. Upper-end consumers in great shape, again, shows up in the polling data, much more supportive of the current administration. But if you think about equities, the problem is not growth. The problem is valuation, right? Your 22 times forward earnings. Whenever you have a 20 multiple or higher, and by the way, we're very sympathetic to the fact that we should have a sustained higher multiple, just given the concentration of markets and the incredible free cash flow margins of mega cap tech. But nonetheless, you tend to have much more muted forward returns. And clearly, there's been a little overextension in the short term. So in the event that yields keep going higher, we could have a mini repeat of what we saw multiple times the last 2 years, where higher yields are driving multiple compression. And then locally, Lisa, the only fundamental problem we see with valuations going into next year, not tied to long-term performance, but near-term, is, nominal GDP has slowed and we expect should continue to slow. Yet markets are pricing in revenue acceleration for the S&P and also approximately a 10% margin expansion. We can get there if the market becomes narrower and narrower. I think mega cap tech, Magnificent Seven minus Tesla plus Eli Lilly, Salesforce going to 40 or 45% of the S&P. But that just seems unlikely to us, given how much broader this rally has become. So, those are curious data points, like 10% acceleration operating margin, reacceleration of revenue. That's a really high hurdle to meet. So, forward returns are just going to be much more muted. And volatility is not going to be as high as it was in 22, but it should be higher than it's been, since October of 22 through today.